Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Simply Good Foods Co. annual report. The Simply Good Foods Company offers a diverse range of consumer packaged food and beverage products under its Quest, Atkins, and OWYN brand names. These include snacks, protein bars, sweet and salty snacks, cookies, muffins, protein chips and crackers, meal replacements, ready-to-drink beverages and shakes, protein powders, recipes, confectionery products, peanut butter cups, brownies, caramel candy bites, chocolatey-coated peanut candies, caramel candy bars. The company also licenses its brands and logos for use on certain products and distributes them through various retail channels, including mass merchandise, grocery and drug stores, club and convenience stores, gas stations, and e-commerce platforms such as Amazon. The significant drop in Simply Good Foods Co.'s SMPL stock price by -41.99% in the past year can be attributed to a combination of factors related to its financial performance and outlook. The company's weak fourth quarter 2025 results, including a net loss and disappointing 2026 outlook, led to investor sell-offs. Additionally, the decline in Atkins brand sales, which accounts for a significant portion of the company's revenue, has been a major drag on overall results. A substantial impairment charge related to Atkins, gross margin compression due to tariffs and commodity prices, and an earnings per share miss have all contributed to the decline in stock value. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth drivers. The acquisition of OWYN and expansion into new markets and products drove significant revenue growth. Increased distribution in major retail channels and the introduction of new products also contributed to revenue growth. Revenue decline drivers. Declines in future revenue projections, changes in assumptions used in estimating fair values, and increased trade promotions led to a decline in revenue. Allowances for trade promotions related to manufacturer chargebacks also contributed to revenue decline. Segment-specific performance. The Quest segment experienced revenue growth due to increased sales, while the Atkins segment declined due to reduced distribution. The OWYN segment initially contributed to revenue growth, but declined significantly in 2024 compared to 2023. Geographic drivers. Revenue growth was driven by increased sales in North America and expansion into international markets. Net income and profit margins. A shift in fortune. The financial performance of a company underwent significant changes between 2023 and 2025. Initially, net income increased by $38.5 million, 39.6%, from 2023 to 2024, indicating a positive trend. However, this growth was short-lived, as net income decreased by $35.7 million, minus 25.6%, from 2024 to 2025. The decline in net income led to a decrease in profit margins. The gross profit margin dropped from 38.4% in 2024 to 36.2% in 2025, while the net income margin decreased from 10.5% to 7.1%. These changes can be attributed to various factors, including increased costs and risks associated with international operations, regulatory risks, inflation, supply chain challenges, tariffs, and business transaction costs. The significant decrease in profit margins highlights the company's vulnerability to external pressures. To mitigate these effects, the company must reassess its strategies and adapt to the changing market landscape. The company's financial performance varied across different segments and regions. The Quest segment stood out as a top performer, driven by volume growth. The OWYN segment also showed promise, with its aggregated performance mirroring that of the Quest segment. In contrast, the Atkins segment struggled due to declining distribution and lower profit margins. On a regional basis, North America was a bright spot, delivering strong results in the 52 weeks ended August 30, 2025. However, the international region lagged behind, with poor performance recorded in the 53 weeks ended August 31, 2024. Management is optimistic about the company's outlook, aiming to lead the nutritious snacking movement through trusted brands. Key strategies include expanding distribution channels, introducing new products, and focusing on protein-rich, low-carb options. Innovation is a key driver, with plans to enhance existing products, innovate flavors and forms, and expand into adjacent snacking products. The company also aims to build a leading platform through disciplined acquisitions and monitor macroeconomic trends. Management believes its sources of liquidity will be sufficient to finance continued operations and growth for at least the next 12 months. Despite inflation risks, management's strategy is designed to drive profitable growth. The company's financial summary reveals that it has not paid any dividends to its shareholders. However, the company has engaged in share buybacks, indicating a strategy of returning value to investors through other means. This suggests that the company is prioritizing capital allocation and shareholder value creation through alternative methods. Concerns about inventory buildup and supply chain disruption are evident in the company's financial summary. Inventory buildup is highlighted by increased shipping and handling costs, a specific number of units, 38,955, mentioned as part of the issue, and higher inventory step-ups compared to previous periods. Supply chain disruptions are also a concern, with global constraints affecting the company, shortages or interruptions in core ingredients, equipment, packaging, and products. Potential risks include high demand, production equipment issues, tariffs, trade policies, delayed transitions to new manufacturers, reduced purchase orders from retailers, and contract manufacturers' noncompliance with regulatory requirements. These concerns are further emphasized by the potential for inflationary pressures, higher costs on ingredients and packaging, and possible shortages or interruptions in delivery. Overall, the company faces significant risks related to inventory buildup and supply chain disruptions that could adversely affect its operating results. That concludes the financial summary for Simply Good FOODS Co. Feel free to comment below, and I will be happy to answer them when possible.